Chapter 11. New Methods of Portfolio Construction, Smart Beta and Risk Parity. From Thomas A. Edison. Results? Why, man, I have gotten a lot of results. I know several thousand things that won't work. As the second decade of the 21st century drew to a close, an increasing number of investors grew skeptical that traditional stock picking could produce a portfolio that was superior to a low-cost, tax-efficient, broad-based index fund. Hundreds of billions of dollars in investment funds began switching from actively managed mutual funds into passively managed index funds and exchange-traded funds. But a new breed of portfolio managers argued that one doesn't have to be a stock picker to beat the market. Rather, you can manage a relatively passive, low-turnover portfolio to accomplish good results more dependably without assuming extra risk. The two new investment strategies are called Smart Beta and Risk Parity, with the implicit promise that they can improve portfolio performance. They have attracted hundreds of billions of dollars in assets. This chapter asks the questions: is Smart Beta really smart? Is risk parity too risky? It is important that investors be aware of the strengths and weaknesses of these strategies and the role they might play in their investment plans. What is Smart Beta? There is no universally accepted definition of Smart Beta investment strategies. What most people who use the term have in mind is that it may be possible to gain excess, greater-than-market returns by using a variety of relatively passive rules-based investment strategies that involve no more risk than would be assumed by investing in a low-cost total stock market index fund. I have argued in earlier chapters that the core of every investment portfolio should consist of low-cost, tax-efficient, broad-based index funds. Indeed, from the first edition of this book in 1973, even before index funds existed, I urged that they be created because such funds would serve investors far better than expensive, tax-inefficient, actively managed funds. By holding a portfolio containing all the stocks in the market, in proportion to their relative size or capitalization, the number of shares outstanding times the price of their shares, the investor would be guaranteed to receive the market return. The substantial evidence cited in earlier chapters makes clear that index funds generally provide higher net returns for investors than actively managed funds that try to beat the market. If an investor buys a low-cost total U.S. stock market index fund, as I have recommended, she will receive the market rate of return as well as assume the risks of the characteristic ups and downs of the U.S. stock market. Remember that the risk of the market is measured by beta, and that the beta of the market is defined to have a value of 1, as presented in the discussion of the capital asset pricing model in Chapter 9. By assuming the risk of being in the stock market, the investor earns a risk premium, defined as the excess return from the market over and above the safe returns that can be earned by holding U.S. Treasury bills. That risk premium for accepting the volatile ups and downs of stock prices has been substantial. Since 1927, stocks have rewarded investors with returns, including dividends and price increases, of about 7 percentage points per year greater than Treasury bill returns. The Sharpe ratio for investors in a broad stock market index since 1927 has been 0.42. But there have been long periods when stocks did poorly and produced inferior returns compared with safe assets. During the 9 years from March 2000 to March 2009, stock prices actually declined. Thus, the equity investor must be able to accept long periods of underperformance. In evaluating the usefulness of tilting a portfolio in any one direction, or in multiple directions simultaneously, we will employ a statistic commonly used by both academics and practitioners called the Sharpe ratio. This eponymous statistic was created by William Sharpe, one of the developers of the capital asset pricing model, CAPM. We know that investors desire high rewards, high returns, and low risk, low volatility. The Sharpe ratio combines both of those elements in one statistic. The numerator is the return from the strategy, or more commonly the excess return over the risk-free rate, usually the 3-month Treasury bill rate. The denominator is the risk or volatility of the strategy measured by the standard deviation of the returns, how variable they have been over time. If strategy A produces a 10% excess return with 20% volatility, and strategy B produces the same return with 30% volatility, we can say that strategy A is preferred because it has a higher Sharpe ratio. It has a higher return per unit of risk. Sharpe ratio A equals return over risk equals 10% over 20% equals 50%. Sharpe ratio B equals return over risk equals 10% over 30% equals 33%. What the smart beta investment managers would have us believe is that pure indexing, where each company has a weight in the portfolio given by the size of the company's total capitalization, is not an optimal strategy. A better risk-return trade-off, that is, a higher Sharpe ratio, can be obtained. The trick is to tilt or flavor the portfolio in some direction, such as value versus growth, small versus large companies, and relatively strong stocks versus weak ones. Other tilts or flavors that have been suggested include quality, encompassing attributes such as stable sales and earnings growth and low leverage, profitability, low volatility, and liquidity. Just as good cooking blends a number of food flavors, some smart beta portfolios mix two or more flavors together. There are portfolios that blend value and small size, as well as those that mix several of the flavors mentioned above. Smart beta strategies are related to the multi-factor models discussed in Chapter 9. Indeed, the technique is often called factor-based investing. If one assumes that the beta of the capital asset pricing model is an incomplete measure of risk, the tilts or flavors listed above can be considered additional risk factors. By tilting the portfolio toward smaller companies, for example, the investor is making a bet that the risk premium that is available from smaller companies can enhance returns. Here, of course, smart beta is interpreted as a technique to enhance returns by assuming additional risk. 4 tasty flavors, their pros and cons. 1. Value wins. In 1934, David L. Dodd and Benjamin Graham published a manifesto for investors that has attracted strong adherents, including the legendary Warren Buffett. They argued that value wins over time. To find value, investors should look for stocks with low price-earnings ratios and low prices relative to book value. Value is based on current realities rather than on projections of future growth. The resulting theory is consistent with the views of behaviorists that investors tend to be overconfident in their ability to project high earnings growth and thus overpay for growth stocks. I have considerable intellectual sympathy with this approach. One of my cardinal rules of stock selection is to look for companies with good growth prospects that have yet to be discovered by the stock market and sell at relatively low earnings multiples. This approach is often described as GARP, growth at a reasonable price. I have warned investors repeatedly about the dangers of fashionable high multiple stocks. Particularly because earnings growth is so hard to forecast, it's far better to be in low multiple stocks. If growth does materialize, both the earnings and the earnings multiple will likely increase, giving the investor a double benefit. Buying a high multiple stock whose earnings growth fails to materialize subjects investors to a double whammy. Both the earnings and the multiple can fall. There is evidence that a portfolio of stocks with relatively low earnings multiples, as well as low multiples of book value, cash flow, and/or sales, produces above-average rates of return even after adjustment for risk as measured by the capital asset pricing model. For example, consider the return from 10 equal-sized groups of stocks ranked by their P/E ratios. Group 1 had the lowest P/E, Group 2 the second lowest, and so on. As the P/E of a group of stocks increases, the return decreases. Another predictable pattern of return is the relationship between the ratio of a stock's price to its book value, the value of the company's assets as recorded on its books, and its later return. Stocks that sell at low ratios of price to book value tend to produce higher future returns. This pattern appears to hold for both U.S. and many foreign stock markets, as has been shown by Fama and French, whose work was described in Chapter 9. Low P/E multiples and low price-to-book value (PBV) ratios can reflect risk factors that are priced into the market. Companies in some degree of financial distress are likely to sell at low prices relative to earnings and book values. For example, the big money center banks, such as Citigroup and Bank of America, sold at prices well below their reported book values during 2009, when it appeared that these institutions could quite possibly be taken over by the government and the stockholders' equity wiped out. The standard measurement of the value factor is referred to as HML, the return on the 30% of stocks selling at the highest multiples of book value minus the return on the 30% of stocks selling at the lowest multiples of book value. From 1927 through 2017, the annual risk premium available from holding a portfolio of value stocks has been 4.9%. Another way to measure the value premium is by calculating its Sharpe ratio. Since 1927, the value factor, as measured by HML, has produced a Sharpe ratio of 0.34, a sizable reward-to-risk ratio that is almost as large as that for the beta market factor discussed above. It is possible to purchase portfolios that divide the broad stock market portfolio into two components, the value and the growth components. The value component holds those stocks with the lowest price earnings and price-to-book ratios. A representative value ETF sponsored by the Vanguard Group trades under the ticker symbol VVIAX. VVIAX is designed to track the performance of the CRSP U.S. Large Cap Value Index, a broadly diversified index made up predominantly of value stocks of large U.S. companies. It attempts to replicate the target index by investing all or substantially all of its assets in the stocks that make up the index, holding each stock in approximately the same proportion as its weighting in the index. The Vanguard VIGAX ETF tracks the performance of the growth component of the CRSP Large Cap Index. Value and growth ETFs are available for small cap broad indexes as well. 2. Smaller is better. Another pattern that academic investigators have found in stock returns is the tendency over long periods of time for small company stocks to generate larger returns than large company stocks. Since 1926, according to Ibbotson Associates, small company stocks in the United States have produced rates of return about 2 percentage points higher than the returns from large company stocks. Fama and French divided stocks into deciles according to their size. They found that Decile 1, the 10% of stocks with the smallest total capitalization, produced the highest rate of return, whereas Decile 10, the largest capitalization stocks, produced the lowest rate of return. Moreover, small firms tended to outperform larger firms with the same beta levels. While more studies have tended to cast doubt on the durability of the size phenomenon, as well as the feasibility of an investor's ability to capture the effect because of the illiquidity of small company stocks, it does appear that size is a factor explaining historical returns. Nevertheless, we need to remember that small firms may be riskier than large firms and deserve to give investors a higher rate of return. Thus, even if the small firm effect were to persist in the future, such a finding would not violate market efficiency. The higher returns for smaller companies may simply be the requisite reward owed to investors for assuming greater risk. Size is therefore a risk factor that deserves to be compensated with additional return. The size factor is calculated by measuring the average annual return of the smallest 50% of the stocks in the market and then subtracting the average annual return of the largest 50% of the stocks. Over the period from 1927 through 2017, the size of the premium was 3.3 percentage points. The size effect produced a Sharpe ratio of 0.23. 3. There is some momentum in the stock market. The earliest empirical work on the behavior of stock prices, going back to the early 1900s, found that a sequence of random numbers had the same appearance as a time series of stock prices. But even though the earliest studies supported a general finding of randomness, more recent work has indicated that the random walk model does not strictly hold. Some patterns appear to exist in the development of stock prices. Over the short holding periods, there is some evidence of momentum in the stock market. Increases in stock prices are slightly more likely to be followed by further increases than by price declines. For longer holding periods, reversion to the mean appears to be the pattern. When large price increases have been experienced over a period of months or years, such increases are often followed by sharp reversals. Two possible explanations for the existence of momentum have been offered. The first is based on behavioral considerations. The second, on sluggish responses to new information. Robert Shiller, one of the leaders in the field of behavioral finance, emphasized in 2000 a psychological feedback mechanism imparting a degree of momentum into stock prices, especially during periods of extreme enthusiasm. Individuals see stock prices rising and are drawn into the market in a kind of bandwagon effect. The second explanation is based on the argument that investors do not adjust their expectations immediately when news arises, especially news of company earnings that exceeded or fell short of anticipation. Some investigators have found that abnormally high returns follow positive earnings surprises, as market prices appear to respond only gradually to earnings information. It is hard to interpret evidence of momentum in the stock market as reflecting risk. It is the case, however, that there are frequent momentum crashes where the stocks that have been market favorites have suffered punishing reversals. Certainly, there is a degree of risk to trend-following strategies. Momentum is typically measured by looking at the last 12 months' return, excluding the most recent month. The most recent month is eliminated because it often exhibits a reversal. The measurement of the momentum factor is the average return of the best-performing 30% of stocks minus the average return of the worst-performing 30% of stocks. From 1927 through 2017, a momentum strategy involving being long in the best-performing stocks and short in the poorest performers generated a risk premium of 9.2 percentage points and a Sharpe ratio of 0.58, both even larger than the CAPM beta factor. Of course, the assumption in the measurement of all the factors is that the investor is long in the stocks with strongest momentum, deepest value, and smallest size, and short in the stocks at the other end of the spectrum. No account is taken of trading costs, taxes, and other possible implementation costs. 4. Low beta stocks return as much as high beta stocks. Recall the discussion in Chapter 9 demonstrating the empirical result that the relationship between beta and return was flat. High beta stocks do not produce the higher returns, hence low volatility can be considered an additional factor that can improve the investor's risk-return trade-off. The relationship between beta and return is relatively flat both in the United States and internationally. Investors can use this fact to fashion a variety of betting against beta portfolio strategies. For example, suppose very low beta portfolios have a beta of 1/2. They are half as volatile as the broad market portfolio, but produce the same return as the market, which by definition has a beta of 1. Suppose the market return was 10%. By buying a low beta portfolio on margin, putting up 50 cents for each dollar of market value, an investor could double the beta and double the return of the low beta portfolio. We shall see in the discussion in the last half of this chapter that such a technique is the basis for so-called risk parity investing. What could go wrong? Whether the strategies work with real money as they do in the data studies is a question to which we will now turn. At least historically, the 4 factors considered above, value, size, momentum, and low beta, have produced good risk-adjusted returns. It would appear that tilting portfolios in these directions could be a smart investment strategy, but in practice, it may not be possible for investors to capture the additional risk premiums that appear to be available. Remember that the actual risk-return results researchers have calculated generally assume that the portfolio is long one factor and short the other. For example, long value, short growth. In practice, such a strategy can involve considerable transactions costs and may be difficult to implement. The cost of borrowing stock to effect a short sale may be very expensive, and the supply of stock available to borrow can be limited. If the factor returns are caused by behavioral errors rather than reflections of risks, they may get arbitraged away over time, particularly as more investment dollars flow into smart beta products. Indeed, there has been a tendency for the factor premiums in the market to attenuate after they are understood and given wide publicity. There are investment funds and ETFs available that allow investors to buy a portfolio that concentrates on each of the 4 factors discussed. The ETFs VTI and SPY allow investors to gain broad market exposure to the total stock market and the Standard & Poor's 500 stock index, respectively. These are the simple index funds I have long recommended to give market beta exposure. As indicated, the ETF VVIAX, sponsored by the Vanguard Group, is a representative value fund that tracks the performance of the CRSP U.S. Large Cap Value Index, a broadly diversified index made up predominantly of value stocks of large U.S. companies. The Vanguard VIGAX ETF tracks the performance of the growth component of the CRSP Large Cap Index. Value and growth ETFs are available for broad small cap indexes as well. Investable instruments that contain portfolios of stocks skewed toward small-sized companies, that is, small cap stocks, are also available. For example, the ETF trading under the ticker symbol IWB tracks the Russell 1000 index of the 1,000 largest U.S. companies. The ETF IWN tracks the small cap Russell 2000 index containing the next 2,000 companies in size, total capitalization. Further, there are ETFs that tilt the portfolio toward stocks that are exhibiting relative strength compared with the whole market. The fund AMOMX, sponsored by the investment firm AQR, invests in large cap and mid cap companies that are determined to have positive momentum. There is also a single factor ETF SPLV, which buys low volatility stocks. There are hundreds of single factor ETFs in the market now, roughly 17% of all U.S. listed ETFs. In addition, there are hundreds of mutual funds designed to concentrate on a single factor. Together, these funds have well over $500 billion in assets under management. Some have been in existence for over 25 years, so that we have substantial evidence of how they work in practice. The evidence is clear that single-factor smart beta products have not produced superior results. We compared 4 single-factor ETF results with comparison simple index funds. In the comparison, we use a total stock market index fund from Vanguard, ticker symbol VTSAX, where the factor fund was designed as a large cap fund. For the low volatility factor ETF, we used a large cap S&P 500 index fund equivalent for comparison. We found the single factor funds have either produced returns that are roughly equivalent to broad-based index funds, or their returns have been inferior. They also have experienced long periods of underperformance. Moreover, there has been no significant improvement in the risk-adjusted returns as evidenced by their Sharpe ratios. The low volatility ETF did produce a slightly higher Sharpe ratio but has an inferior return. Smart beta investing with single-factor products has not turned out to be smart investing. Blended factor strategies. Thus far, we've considered employing factor tilts or flavors such as value, size, and momentum singly in constructing portfolios. We can now examine whether blended strategies, where different tilts or flavors are applied simultaneously, may produce more consistent results. Perhaps diversification among the different factors can produce enhanced returns or lower risk for a given level of return. Factor diversification should help if the correlation between factors is small, as we showed in Chapter 8 on portfolio theory. If the correlation between some factors is actually negative, we should expect even higher risk-adjusted returns from blended strategies. In fact, the correlations between factors are low or negative. For example, the momentum factor is negatively correlated with the market beta, value, and size factors. Thus, results should be improved by capturing the potential diversification benefits of using blended factor strategies. For example, when value tilting is not working, an exposure to momentum will tend to enhance returns. Andrew Burton and Larry Swedroe, the authors of an excellent guide to factor investing, simulated results from building portfolios by combing the different factor tilts. The blended portfolio is allocated by placing 25% of the invested funds in each of the 4 factors: market beta, size, value, and momentum. We note that the blended portfolio exhibits a dramatically lower instability, standard deviation of returns, and a much higher Sharpe ratio. Of course, these simulated results do not take account of any management fees or transaction costs. Moreover, the individual size, value, and momentum segments are long/short portfolios, and it is assumed that there is no difficulty effecting short sales. For example, the size portfolio holds the smallest stocks as a long position while selling short the largest stocks. The question remains whether the simulated gains in portfolio performance can actually be achieved in practice. Blended funds in practice. Dimensional Fund Advisors, DFA. Dimensional Fund Advisors was formed in the early 1980s to provide investors with vehicles that apply blended factor strategies to actual portfolios. The portfolios are designed using the size and value factors in the original famous French three-factor model, augmented by a tilting toward strong recent price momentum and strong profitability growth. DFA had well over $500 billion of assets under management at the start of 2018. DFA funds have experienced somewhat better performance than many of the other smart beta offerings available to investors. They are generally low cost, with expense ratios only moderately higher than the fees of broad-based capitalization-weighted ETFs. However, they are sold only through investment advisors. The investment advisors from whom DFA funds are available are fee-only, that is, they do not collect extra commissions for placing investors in particular funds. Thus, these advisors tend to be unconflicted, unlike many other advisors. Nevertheless, advisors charge advisory fees that could range up to 1% or more, and therefore the extra returns that have been available from many DFA funds need to be reduced by these fees. DFA is quite explicit that any extra returns represent an appropriate compensation for the added risk of the portfolios. Note also that the DFA funds, like all the smart beta funds, experience periods of underperformance. Research Affiliates Fundamental Index, RAFI. By the criterion of commercial success, the RAFI smart beta funds have also been successful in gathering assets. As of the start of 2018, Research Affiliates had over $200 billion under management. Unlike DFA, Research Affiliates claims that market inefficiencies rather than risk explain whatever excess returns are produced. The founder of Research Affiliates, Robert Arnott, is able to hold audiences spellbound as he argues that capitalization weighting, that is, weighting by the market value of each company, implies that holders of such portfolios will always be holding too big a share of overpriced growth stocks. He avoids this problem by adjusting the weight of each stock to its economic footprint, such as earnings, assets, and the like. He calls this fundamental indexing. Of course, this weighting gives the RAFI portfolios a tilt toward value and small size so that the portfolios are similar to other multi-factor smart beta offerings. The RAFI ETF trades under the ticker symbol PRF. One period when PRF delivered excellent results was 2009. The RAFI portfolio substantially overweighted large bank stocks in 2009, coming out of the financial crisis, since these stocks sold at unusually large discounts from their book asset values. The RAFI Fundamental Index portfolio had about 15% of its portfolio in two stocks, Citigroup and Bank of America, at that time. It turned out that this overweighting helped produce excellent returns. But it was far from clear at the time that the troubled banks would avoid nationalization. In any event, the strategy involved considerable risk. It is hard to avoid the conclusion that whatever success RAFI has had in generating excess returns resulted from the assumption of greater risk rather than from the mispricing of growth stocks. Goldman Sachs Active Beta ETF. Goldman Sachs introduced their Smart Beta Fund in 2015. The exchange-traded fund trades under the ticker symbol GSLC. The Goldman ETF relies on four factors: good value, strong momentum, high quality, and low volatility. The expense ratio of the fund was only 9 basis points, 0.09%, the lowest of the smart beta offerings. This expense ratio is close to the lowest total stock market index fund that simply buys and holds all the stocks in the market. Equally weighted portfolios. By weighting each stock in an index equally rather than weighting by its total capitalization, an investor can obtain similar results to those from some of the multi-factor models. An equal-weighted S&P 500 portfolio would include each stock at a 1/500th weight. Equal weighting therefore increases the weight of both small companies and value stocks, while decreasing the weight of the most popular by capitalization growth stocks such as Amazon and Alphabet, Google. The Guggenheim Equal Weight 1000 ETF ticker symbol EWRI, invests in each of the stocks in the Russell 1000 index at a 1/1000th weight, and the portfolio is periodically rebalanced. Equally weighted portfolios have diversification and risk characteristics quite different from those of capitalization-weighted portfolios. They are also tax inefficient, as rebalancing involves selling stocks that have risen the most in price so as to reduce their weight in the portfolio. The records of the multi-factor funds have been somewhat promising. Because they've been able to benefit from the low or negative correlations between the factors, they've been able to provide moderate increases in return, with sharp ratios very close to those of the broad stock market indexes. They can be somewhat less tax efficient, however, as the rebalancing involved in the execution of the strategy can produce taxable capital gains. Also, investors need to be aware of the extra fees that will be imposed in accessing multi-factor funds that are only available from investment advisors. Implications for investors. Smart beta strategies rely on a type of active management. They are not active in the normal sense of the word. They do not try to select individual stocks, but rather they tilt the portfolio toward various characteristics that have historically appeared to generate larger than market returns. In their favor, the smart beta portfolios provide these factor tilts at expense ratios that are often considerably lower than those charged by traditional active managers. In general, the records of single-factor smart beta funds and ETFs have been spotty. Many single-factor ETFs have failed to produce reliable excess returns. Moreover, these funds are less tax-efficient than capitalization-weighted funds that do not require rebalancing. Multi-factor smart beta funds appear to have produced better results by taking advantage of the low or negative correlations between the factors. Especially if they can be obtained with low expense ratios, they could supplement a broad-based core index portfolio. But any excess returns or more favorable Sharpe ratios should be interpreted as a reward for assuming extra risk. In departing from the market portfolio, investors are taking on a different set of risks. Smart beta portfolios may not represent a sophisticated, better mousetrap for investors. Investors should be wary of getting caught in the riskier mousetrap themselves. Smart beta portfolios have been the object of considerable marketing hype. They are often a testament to smart marketing rather than to smart investing. Whether the smart beta strategies will turn out to be smart investing in the future depends crucially on the market valuations existing at the time the strategy is implemented. U.S. value strategies performed extraordinarily well coming out of the internet bubble when technology growth stocks were priced richly relative to most value stocks. Similarly, small cap stocks did particularly well when they're inexpensively priced relative to large caps. Investors should be aware that if value and small size become richly priced, as smart beta funds become increasingly popular, the results could well be disappointing. Strategies that become well known often lose their effectiveness after publication of their results. This is especially so if they rely on pricing errors rather than compensation for risk. Thus, there is no reason to adjust the long-standing advice of the earlier editions of this book. The core of every portfolio should consist of low-cost, tax-efficient, broad-based index funds. If you do want to take a chance that some risk factors will generate improved risk-adjusted returns in the future, you can do so most prudently if the core of your portfolio consists of capitalization-weighted, broad-based index funds. And if you do want to add additional risk factors in the pursuit of extra return, I recommend a low-expense multi-factor offering rather than a fund concentrating on one risk factor. Risk parity. Ray Dalio is a unique individual. He is at once a billionaire who is one of the richest people in the world and a #1 best-selling author. He runs the largest hedge funds in the world at Bridgewater Associates, where he developed the enormously successful risk parity fund called the All-Weather Fund. In his book, entitled Principles, he describes the more than 200 principles that guided his firm. Whether Principles is a template to show people how to succeed in the investment business is unclear. Certainly one can't argue with the idea that investment strategies must be evidence-based and tested against vigorous debate and criticism of others. But the work environment that Dalio created at Bridgewater has been described as toxic. Dalio insists that employees be constantly evaluated with radical honesty rather than with kindness in an attempt to bring their performance up to a higher level. Each day observations, so-called dots, are collected regarding the effectiveness of the organization and its individual people. All meetings are taped. Employees are subject to public criticism, and each one has a baseball card detailing his or her weaknesses that is available online for everyone in the organization to see. The public criticisms of employees who don't measure up are called public hangings. Employees are told to look to the example of a pack of hyenas murdering a young wildebeest as a blueprint for how to deal with each other in the workplace. Small wonder that a third of Bridgewater employees leave the firm within a few years. One employee complained to the Connecticut Commission on Human Rights that Bridgewater was a cauldron of fear and intimidation. But there is no denying that the organization has produced uncommon investment results, and some people have appreciated this hardline culture. One of these was a former employee, James Comey, of FBI fame. Comey has said, "I've been probed in this strange field trip through life that I've had in a lot of different places. I've testified in court, I have briefed the President of the United States repeatedly, I've argued in front of the United States Supreme Court, and I've been probed at Bridgewater. And Bridgewater is by far the hardest. And for all you can criticize Ray Dalio," Comey said, "he is one smart bastard." One of Bridgewater's greatest successes had been the development of risk-parity investment techniques. The evidence-based principle on which it rests is that relatively safe assets often provide higher returns than are appropriate for their level of risk, while riskier assets are relatively overpriced and return less than they should. Investors can therefore improve their results by leveraging low-risk assets, buying them with some borrowed money so as to increase their risk and return, as will be shown in the examples that follow. The risk parity technique. There are two methods by which an investor can hope to increase the return and risk of a portfolio. One technique is to overweight the portfolio with higher risk assets such as common stock. A second plan is to invest in a broadly diversified portfolio with a substantial weighting of relatively safer assets promising modest returns and relatively low expected volatility. This relatively safe portfolio can then be leveraged up to increase both its risk and return. The essence of risk parity is that the second strategy can in some circumstances offer the investor a better expected return per unit of risk. To be sure, leveraging can create its own unique set of extra risks, since a leveraged investor is less able to ride out a temporary storm that often engulfs financial markets. But for investors, especially those with high net worth, with the capacity and temperament to accept the additional risks of leverage, the bargain offered by risk parity portfolios may be sufficiently attractive to deserve a place in the overall portfolio. There is considerable evidence that individuals appear to overpay for wagers that offer a slim likelihood of winning, but a large potential payoff if they are successful. Imagine you are at a racetrack. If you bet on every horse, you would be guaranteed to hold a winning ticket, since one horse will always win the race. But after collecting your winnings, you would find that you lost about 20% of your money, since the track figures the payoff only after deducting 20% from the total amount bet to take care of taxes, expenses, and profits. If you continued to place bets on every horse, race after race, you would consistently lose 20% of the total amount bet. In every race, there are long-shot horses, considered the most unlikely to win but with the largest potential payoffs. Suppose you thought the prospect of such big payoffs was so attractive that you bet on the longest shot in every race. You would win occasionally, but over time you would lose approximately 40% of the amount bet. On the other hand, if you bet the favorite in every race, you would win about a third of the time. Still, over time, you would lose, but only about 5% of the amount bet. While there is no surefire way to win at the racetrack, unless you have inside information that a particular horse was drugged, it is less bad to bet favorites consistently than to bet long shots. Horse race gamblers overpay for long shots and the excitement of the possibility of winning big. While in general the betting odds do a good job of predicting the order of finish, people overbet long shots and underbet favorites. In the world of asset classes, there are also favorites and long shots, and there also appears to be a tendency for investors to overpay for the long shots. A striking similarity between payoffs in the stock market and at the racetrack is that there is a tendency for people to overpay for investments with high risks but a possibility for unusually high returns. Very safe stocks and other safe assets appear to offer higher returns than their risk would warrant. We saw a perfect example of this finding in our discussion of the capital asset pricing model in Chapter 9. In Chapter 9, we reviewed the original Fama French study showing that high beta stocks, those with the highest sensitivity to general declines in stock prices, do not provide investors with any higher rates of return than more stable stocks. Subsequent studies have confirmed these results. These findings underlie one possible risk parity strategy. If the historical pattern of a flat return beta relationship continues, it will be optimal to buy low beta assets on margin to increase risk and return of the portfolio to the level the investor desires. By employing enough leverage, it will be possible to increase the portfolio beta to the same level as a market portfolio. But the investor will earn a higher than market rate of return if the historical pattern continues. Safe bonds may also provide opportunities to employ risk parity techniques. The finding that low-risk assets appear to produce higher rates of return than seem warranted by their risk characteristics holds up not only within the stock market but also among different asset classes. Bonds are about half as volatile as stocks. The volatility of bond returns is about 50% lower than is the case for stock returns, 2% standard deviation of returns for stocks versus less than 1% for bonds. But bonds have produced average returns of 7.1% versus stock returns of 11.4% over the 50-year period ending in 2016. Risk parity recognizes such apparent empirical regularities and attempts to take advantage of them by buying bonds on margin to increase the bond portfolio's rate of return while increasing the investor's risk up to the level of risk inherent in holding a portfolio of common stocks. Over the 2007-2016 period, an investor buying bonds on 50% margin would double her return and double her risk. The precise calculation would need to include the cost of funding the leveraged position as, for example, borrowing at the risk-free rate. If the margin purchase was financed by borrowing at the risk-free rate, the return on the leveraged bond investment would be reduced to 9.9%. But even if she borrows the money and pays an interest rate at or somewhat higher than the short-term risk-free rate, the same advantage continues to hold. The desired leverage can also be established using derivative markets. The embedded cost of borrowing through derivatives is typically lower than the cash financing rate. For every $100 of bonds purchased, the investor has only $50 invested. This technique doubles the investor's return at the expense of doubling the volatility, standard deviation, of the investment returns. Risk parity versus the traditional 60-40 portfolio. An alternative argument for risk parity can also be supported using the techniques described in Chapter 8 in our discussion of portfolio theory. Many institutional portfolios and balanced funds contain 60% stocks and 40% bonds, or use the 60-40 benchmark as a proxy for their performance benchmark. Risk parity, however, may provide a better risk-return trade-off. The 60-40 portfolio would appear to be very prudent and well-designed to protect investors from the inevitable sharp dips in the stock market. In fact, about 90% of the volatility in these portfolios comes from the 60% portion invested in stocks. Moreover, in the crisis year of 2008, 60-40 portfolios lost over 25% of their market values. We can easily demonstrate that a 60-40 portfolio may not be optimal. Think of the locus of points, called the opportunity locus, as representing all combinations of stocks and bonds and the risk-return characteristics produced by the alternative portfolios. The lowest risk portfolio consists of 100% bonds, since bonds have a lower standard deviation than stocks. By adding some stocks to the portfolio, we can obtain a higher rate of return, since stock returns have historically been higher than bond returns. For at least some combination of stocks and bonds, the standard deviation of the resulting portfolio can decline, since bonds have typically had low and sometimes even negative correlations with stocks. Eventually, however, as we move to a 100% stock portfolio, risk increases since the standard deviation of stock returns exceeds that of bond returns. Two additional points along the curved locus are of interest. The portfolio consisting of 60% stocks and 40% bonds lies along the locus close to the end of the point representing all stocks. Also, we will call the portfolio at the tangency point the risk parity RP portfolio of stocks and bonds. An investor can move along the line to the right of the RP point by purchasing the RP portfolio on margin, borrowing at the risk-free rate. All the investment alternatives along the tangency line provide as good or better risk-return trade-offs than portfolios on the curved locus. In particular, the leveraged RP portfolio clearly dominates the 60/40 portfolio. It has the same risk as the 60/40 portfolio, but it offers a higher return. Dalio's All-Weather Fund. Thus far, we have illustrated risk parity portfolios using only two asset classes, stocks and bonds. In practice, risk parity portfolios will include a number of asset classes, and overall portfolios will include more than just stocks and bonds. For instance, real estate assets, accessed, for example, with an REIT index fund, could be included in the overall portfolio. So could commodity funds as well as Treasury inflation-protected securities, TIPS. Indeed, the overall risk parity portfolio could benefit substantially by adding additional asset classes. As long as the added asset class has a relatively low correlation, or at least not a very high correlation, portfolio effects would tend to lower the volatility of the overall portfolio. Moreover, the different asset classes would react differently to different economic conditions. This is why Bridgewater Associates calls its risk parity offering the All-Weather Fund. Note that the technique does not rely on active portfolio management. The component parts of the portfolio could be indexed and passively managed just as well as being actively managed. The technique does not rely on switching among asset classes according to the timing instincts of the portfolio manager. Moreover, risk parity is applicable even if other risk measures, such as downward sensitivity, are deemed to be more appropriate than overall portfolio volatility. What is required is that asset allocations are adjusted so that all components of the portfolio contribute equally to portfolio risk. What could go wrong? The risk parity approach gained in popularity during the financial crisis because RP portfolios tended to outperform traditionally weighted portfolios with their significant allocations to equities. Different RP approaches will use different weightings and different assets, but all tend to give fixed income securities a heavier weight than is the case with standard portfolios. While RP is not simply a bet on leveraged bonds, the risks involved in that feature of the plan need to be considered carefully. Bonds have produced excellent risk-adjusted returns from the early 1980s to the late 2010s. This permitted risk parity investors to buy bonds with leverage and obtain a net return higher than that available from common stocks. But in the early 1980s, U.S. Treasury bonds had double-digit yields. In 2018, 10-year Treasury yields were about 3%, only slightly more than half of their historical returns since 1926. Particularly if yields rise to more normal levels, the prices of bonds will fall, further reducing their rates of return. While interest rates may remain low in the slow-growth, non-inflationary environment predicted to continue by many economic forecasters, bonds are highly unlikely to produce returns anywhere near as high as they did during the 1982-2018 period. Leverage is a potentially dangerous tool for investors. An unlevered investor can continue to hold a bond that has fallen in price, hoping that eventually the price bounces back or the bond matures at par. The levered investor may be forced to liquidate his position during a sharp downturn in prices and thus be forced to turn a temporary loss into a permanent one. Thus, while bond returns may have low volatility under normal circumstances, that volatility could rise sharply and exhibit a significant negative skew. It is also possible that other asset classes in the risk parity portfolio may fail to produce adequate risk premiums and may not have the same correlations with economic conditions as they have had in the past. Commodities as an asset class are often praised as a low volatility asset with the desirable feature that their correlation with inflation makes them a very useful part of the well-diversified portfolio. But historically, the return from commodity futures has resulted from future prices systematically undershooting the cash price realized at the end of the futures contract. This so-called roll return is added to whatever return might be expected from the tendency of the commodity prices to rise with the general level of inflation. But as more investment money has entered into the commodities market, the roll premium has tended to dissipate and even become negative. Moreover, commodity indexes may have a less favorable correlation with inflation than they have enjoyed in the past. Many commodity indexes have a very heavy weighting in oil. With the abundant availability of shale oil and the movement to alternative sources of energy, the relationship of oil prices to the general level of inflation may be different in the future than it has been in the past. Risk parity portfolios will not be helped by leveraging an asset class with a non-existent risk premium. The actual historical results from the Bridgewater All-Weather 12% Strategy Fund shows the fund produced returns close to the returns for all equity index funds with substantially lower volatility. Thus, the Bridgewater Fund had a higher Sharpe ratio. As compared with the 60-40 Balanced Index Fund, the All-Weather Fund had a higher rate of return but also a higher standard deviation. Its Sharpe ratio was somewhat lower than that of the Balanced Index Fund. Risk parity portfolios will not be optimal in all economic circumstances. Nevertheless, the use of leverage is one investment technique that needs to be in the investor's toolbox. In my view, risk parity should not be considered as simply a leveraged bet on holding fixed income securities. Rather, the technique should be judged as being appropriate in some circumstances for investors who hold a broadly diversified portfolio, including international securities, and wish to enhance the entire portfolio's return and risk with the use of leverage. High net worth investors who seek to have a part of their portfolio in higher return assets and who have the capacity to accept the risk of employing leverage should consider adding a risk parity portfolio to their other investments. As between concentrating the portfolio in higher return investments or enhancing returns with leverage, the latter strategy can be more effective. To obtain a higher return without leverage, the investor would have to hold a less diversified portfolio concentrated in higher risk asset classes. Concluding comments. Investors should certainly be aware of new methods of portfolio construction, and high net worth investors might consider adding a multi-factor smart beta offering or a risk parity portfolio to the overall mix of their investments. Factor investing can potentially increase returns at the cost of assuming a somewhat different set of risk exposures than those of a standard broad-based index fund. And investors who are able to accept the added risks inherent in leverage might profitably add a risk parity portfolio to their set of investments. Such offerings should only be considered, however, if they are low cost and if their potentially adverse tax effects can be offset in other parts of the overall portfolio. And I continue to believe that a broad-based total stock market index fund should be the core of everyone's portfolio. Certainly for investors who are starting to build an equity portfolio in planning for retirement, standard capitalization-weighted index funds are the appropriate first investments they should make.